Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, April 19th, 2023. And our top story today is long-term care insurance, an important employee benefit. And joining me now to discuss this and a lot more, Phil Snyder is a senior vice president at the Warner Companies. He's also my dad. Dad, great to see you. Thanks so much for joining us on the program this morning.
Again, it's my pleasure, Jeff. Good morning to you.
Yeah, a little father-son, time, and we appreciate that. And the audience gets to benefit, I guess, a little bit from that. All right, Dad, let's talk about long-term care insurance. And we both know people who are caregivers or who are going through certain situations right now where they need assistance, they need help. How important is that long-term care insurance benefit, do you think, to helping this or achieve this need?
Well, we talked a little bit about long-term care some weeks back, as I recall, and we really delved into the need to plan. People need to sit down with their family members and their advisors, whomever they place their confidence in, and figure out how are they going to handle these costs, which can be quite substantial later on in life if they arise. Clearly, they don't arise in every situation. And clearly, people in many cases will have assets that they could use, at least in part, to pay for some of these costs. Others may not have substantial assets, and they're going to need to rely on others or on other forms of, for example, insurance to provide the funds to handle these costs. So I think it's really, really important that people plan. Having said that, I don't think everybody needs to buy this coverage, certainly, and not everybody needs to fully insure what could be the anticipated costs. So every situation effectively is different, Jeff, and that's, I think, the best way to approach it. When you're talking about this, you need to talk through all aspects of this planning with people to figure out exactly how they're going to meet these needs if and when they arise.
So, and thanks for that. I think that's a great table setter. Longtermcare.gov, which I assume is part of the Health and Human Services of the United States federal government, could be wrong. Assisted living costs average $54,000 a year. So figure this is the last couple of years of life, 5 years of life. Though, if that's average, and by the way, that cost is going to go up. That's a lot of money that you're going to have to allocate to this benefit, and it's probably not even a huge benefit that you're getting. I mean, there's probably a lot of things you're missing out on. That seems like a lot of money to me.
Well, it is, and I think it's low. And of course, those costs are going to vary from state to state and location from location within each state. I think costs generally are higher in the Northeast than they might be, for example, in the Southeast. So there's all kinds of numbers out there, but by and large, these costs are going to increase. They're continuing to increase. 3.5% a year. And people are going to have to figure out how they're going to pay for these expenses if and when they incur them. It's not uncommon for people to look to other family members to provide care, at least care at home. But ultimately, as people's situations regress, let's call it, they may, in fact, need institutional care, be it assisted living, be it nursing home care. Again, the need for nursing home care is probably, that might be a 1 or 2 year need at most. Of course, every circumstance is different. People can linger in nursing homes for long periods of time. People can be never in a nursing home. Every circumstance is different. What's important to realize is many people feel that Medicare, as an example, is going to pay for this. And that's clearly not the case. There are some very limited benefits available under Medicare, but nothing significant that can really impact your need to plan. So I think I'm back to the planning, and I know I'm harping on that. And I know there are products out there that will create money when expenses arise. And I think people should consider those as part of their overall plan.
So let's talk that through. And unfortunately, we're gonna have to do this in multi-parts, but let's just, for the next couple minutes, let's talk about, do I go to a financial advisor, a financial planner? To whom would I go? Do I go direct to the companies? We'll talk about the products in a minute, but to whom would I go to? Would I go to a Phil Snyder as an example to help me get long-term care?
Sure, absolutely. I think the last thing you would do is likely go directly to an insurance company. I'm not sure you get an unbiased feedback if you did that. But if you went, you want to go to people whom you trust. That could be your favorite uncle. It could be your CPA. It could be your attorney. It could be your next door. It could be anybody, and perhaps more than one person should be involved, whom you feel has an awareness of your situation, an awareness of what's happening in the marketplace generally, and rely on that person to give you guidance if in fact you don't have the wherewithal to guide yourself properly. So the last place I would go is to an insurance company initially. I might go to an insurance company after I know that I want to buy insurance, but I wouldn't do that until I've worked through all the other numbers to figure out how am I going to manage this, if in fact it arises. And bear in mind, not to belabor the point, but bear in mind, not everybody is impacted with long-term care expenses. So you have to look at your family history. You have to look at the longevity in your family, the instance of requirement of care within your own family history. Not that that's 100% foolproof, but it's another way to measure what is going to be my likely exposure later on in life. And when I know what that is, how am I going to pay for it?
All right, let's talk about, we've only got a couple minutes left.
Sure.
I know I said that last time, but I'm gonna extend the segment. My producers are gonna yell at me, but that's okay. Let's talk about the different product types. So if someone's, I think you need to be prepared. Even if you go to an expert, you got to be prepared. You got to do a little due diligence on your own.
Absolutely.
And there may be some not great information on the internet. I certainly wouldn't go to TikTok or Twitter or one of those things to get a 30-second soundbite. But let's talk for a few minutes on the different types of products that I could buy as a patron, as a consumer.
And I'll try and make it brief. One, you could buy long-term care insurance. This is a freestanding product. It's not as prevalent as it used to be. There aren't many companies out there selling the product at this point in time, but that's just a use it or lose it product. In other words, you buy the product, the premium for the most part is not fixed and guaranteed. It can change in the future, and it pays a benefit if and when you incur long-term care expenses. The problem with the product is if you never incur expenses, you get nothing from the product. So it's in that sense like homeowners insurance. The insurance industry has evolved, the life insurance industry. You can buy a life insurance policy, a permanent policy, universal life, whole life, whatever the case may be, and attach a long-term care rider or a benefit that would pay for expenses or reimburse for expenses or indemnify you for expenses, depending on the product, that are incurred for long-term care, typically at a percentage of the death benefit. So you can buy, let's say you buy a $500,000 policy with a 2, 3, or 4% distribution to pay for long-term care expenses. That would be a $10,000, $15,000, or $20,000 benefit maximum per month to pay for expenses. Those benefits reduce the death benefit under the policy. That's one form of product. That's really a life insurance policy with a long-term care feature. The other flip side of that, I would say, is what they call a linked benefit policy, where you're buying a very small life insurance policy with a robust long-term care benefit. The only purpose of the life insurance is to provide a death benefit in the event the money that you collect under the long-term care feature of the policy is something less than you paid to buy the policy. So if in fact you paid $100,000 to buy the policy and you recovered $50,000 of long-term care reimbursement expenses, another 50 would be paid at your death to reimburse for the cost. So therefore, the cost for that type of product is the lost opportunity cost that you could have realized by investing the money elsewhere. So that's kind of the range of products other than annuity products, and we haven't gone into annuity products at this point.
Yeah, we're gonna have to say that, but just in terms of the frequency of the premium, in both product sets, how often do you pay one lump sum annually? Do you pay semi-annually, monthly, quarterly? How does payment to these products work?
Linked benefit policies can typically be structured Single pay, one premium pays it up, totally guaranteed. These products are fully guaranteed. There are no variables in these products typically. So single premium, 5 premiums, 10 premiums, premiums to age 65 or 70, or premiums payable in all years. And obviously a single premium is paying it all up in 1 year. An annual premium is being the lowest, is the lowest payment you can make per year. With a life insurance policy, depending on the type of policy you buy, the premiums can be consolidated into a shorter period of time, or they can be extended. Depending on the type of product, however, you could have premiums recur downstream if those policies underperform. And I'm simplifying this because there's a lot more to it than we have the time to explain at this point. But there are a lot of competent people out there who know the marketplace, who can help people reach their best decisions as to what product is appropriate, how much of it is appropriate, what's the availability of the product given people's health at that point in time when they apply. So I know I'm racing around a little bit trying to give as much feedback as I can and help the people who might be viewing this to give them a little bit of guidance to find someone who's competent who can help them.
Yeah, really important.
And then that individual, once we kind of settle on what's an appropriate solution, and if it involves insurance, then we can go to the market and we can get a whole bunch of proposals from a bunch of insurance companies, and we can look at them and evaluate them and help the client make the best buying decision he or she can.
Yeah, well, this is certainly, look, we're living longer, but we're in an aging society. This is probably one of the most important issues that we all will face. We're all getting older. And by the way, we're all going to check out at some point. Dad, as I said, we need to take a very quick break. When we come back, we're going to talk about in-force life insurance policy illustrations. If I say that 3 times, you're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're joined this morning by Phil Snyder, Senior Vice President for the Warner Companies. Dad, thanks so much for sticking with us this morning.
Oh, I'm happy to be here, Jeff. Hope it's helpful.
Yep. All right, Dad. Let's talk about in-force life insurance policy illustrations. I think I have an idea what this is. You know, every time you buy life insurance, you get some type of illustration at the beginning during the sales process. But what is the clear definition of an in-force life insurance policy illustration? We got to come up with an acronym, but what is it?
Okay. I guess what I would call it is a snapshot, a current snapshot of how your policy is performing when compared to how it was originally illustrated. In other words, what you bought when you bought the policy, how does that compare to reality today, how the policy is performing? And this is an integral part of any broker or agent's responsibility to help clients remain aware of how their products are performing.
Yeah, I mean, and do like variables. I'm assuming interest rates change over time. The calculation of longevity changes over time. I mean, there's data that is being gathered from the insurance pool that I'm sure is being factored in to these illustrations that maybe weren't being factored in when you got the original sales illustration.
Yeah, well, I mean, let me give you a couple of quick examples, and the various products dictate different ways that you would approach this. But we have any number of clients who bought products years ago, and the assumptions built in those products were higher interest rates, an assumed level of ongoing mortality costs within the policies, policy expenses, and whatnot. But things change. Interest rates have changed dramatically. We're seeing an uptick in interest rates now that hasn't necessarily manifested itself in crediting rates within insurance policies. Then again, you have other insurance policies that credit interest based on external performance of the investments within the policy, whether those are tracking index performances, for example, the S&P year over year, Standard & Poor's, how does that perform? And tracking that and crediting interest rates based on that performance. You have variable policies where people select from an array of choices within the product to invest their money. So you have all kinds of products out there. You do have products that are fully guaranteed as well, so you're not so concerned about their performance because you knew up front that you had a long-term guarantee. But you do need to look at these products not just from the product performance standpoint, but how suitable do they remain given changes in client circumstances? Someone who bought a policy when they were perfectly healthy may have had a stroke 2 years ago, which may shorten their life. So you have to evaluate that. Needs change over time. So it's product performance is one component of an overall review.
And
Go ahead,
do you
I'm
do
sorry.
this? Sorry, I didn't mean to interrupt you, but in terms of frequency, is this done annually? Is there a cost to ask for an in-force life insurance policy illustration? We're going to come up with an acronym at the end of the show, but is there a cost, and what frequency do you do it?
We don't, in our practice, we don't charge. That's just service. That's just what you do to stand behind the product you sold to people, to make sure that it's going to function and it continues to function as it was originally intended, unless circumstances change. I don't know that other people charge for that service. I don't believe the insurance companies themselves charge to get illustrations. And illustrations are just a current snapshot, as I said earlier, comparing reality today with what you bought 5, 10, 15, 20 years ago. Because if your policy is underperforming, that forces you to make some decisions about that policy. Do I keep the policy? Do I add more money to it? Do I reduce the face amount? Do I not pay premiums because my health has declined so much that my life expectancy is reduced? There are all kinds of issues that arise and things that need to be discussed.
Yeah, and I mean, it would seem to me, just coming from the retirement industry, we always talk about reviewing whether you're an employer sponsoring a plan or if you're an individual. We always talk about, hey, January is a great time or April is a great time to look at your account and to see, am I on track? Am I not on track? It would seem to me that this illustration would be good for around the same time, as would, by the way, the conversation about long-term care if you needed it.
Yeah.
Some of the other facets around the budget and your future budget.
Yeah, I think, well, that's correct. It's an element of a review. A policy review is an element of a review. It's not in and of itself an all-encompassing function. But yeah, I think that in terms of frequency, I would say it at the outside probably every 2 years, maybe 3 at most. For many of our clients, we're doing them every year, and we do it automatically. And if we need to sit down with the client because things have changed and the policies are underperforming, then we're going to do that and show them alternatives, ways they can either make changes one way or another, increase funding, reduce funding, continue the face amount. In some cases, you may want to look to replace an underperforming policy. The problem with that is you then have to be insurable to do that. When you bought the policy, you were maybe a preferred risk, and now you're no longer a preferred risk. So you have to look at what are my choices? And that's a little bit of a process, but everybody should be going through that. Now, that doesn't necessarily apply if you have a term policy, because a term policy has no cash value. It has no intrinsic value. Typically, it's a fixed premium for a period of time. The only thing you have to do there is make sure that the coverage that you bought is adequate and still fits the need. Other than that, there's no policy review as such. So
Yeah. Is there
hopefully that's helping.
Yeah, is there any time I can think if the policy is underperformed, that would mean, hey, we've got to make some changes, either add more contributions, change the investments mix, etc. Is there ever a time where you've had a great performance, you've had a great run, but you still need to make a change? So it's everything's been hunky-dory, the policy has done what you needed it to do, but we still need to make a change.
Well, sure. I mean, circumstances change. Maybe the product is performing better than you had anticipated, and perhaps you need to continue to pay premiums at the same level, if at all.
Yeah.
But we've had a circumstance last year where we had a new client who came to us with policies that were, when he bought them, dividend-paying policies. Those policies, that insurance company then sold its block of business to another insurance company and effectively removed itself from the life insurance business, and the new company is no longer paying dividends. Well, that's a big red flag to be reviewed, because a lot of the benefit of those types of policies is in the dividends. If you're not going to get them, it changes the entire cost structure of the policy going forward. So
yeah,
there's a lot to this, and every policy stands on its own.
Yeah, and if you don't have dividends, then
So
you're going to have to fund it.
When we do this in our practice, what we'll do, and others do this, we're not unique in this respect. We're going to get an authorization from the client or the policy owner. We're going to go to the insurance companies, even if we didn't sell the product, and we're going to gather information. And that's a process that can take several weeks into a month or two to get all the information we need. Then we're going to go sit down with the client and talk about policy to policy, where there are multiple policies involved, as a component of the overall planning strategy.
Yeah,
so that's what we do, and I think others do that very well.
Yeah, well, it's clear that you gotta monitor all investments, whether it's an insurance product or a mutual fund or an ETF or an alternative. You got to make sure it is doing what you expect it to do. Dad, unfortunately, we're going to have to leave it there. Always great to talk to you in a business sense. We always, just for the audience, this isn't the only time we talk. We talk regularly on a regular basis about a lot of business stuff, but non-business stuff too. Dad, great to see you. Thanks so much for joining us, and we look forward to having you back on the program again.
My pleasure. Jeff, it's my pleasure. Good luck.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? We'll visit our website, and of course, all of our streaming partners. We're backing in tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes. Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Tax audits, tax liens, wage garnishments.
Every day we hear stories like this about good folks who are simply struggling to pay their bills. Each of them are living a frightening IRS tax nightmare, and they are afraid it will destroy their lives.
I'm a divorced single mom, and my ex-husband left me and the kids with a lot of unpaid bills, including unpaid taxes. I was really starting to show my stress on my kids because the IRS had sent me a letter demanding a huge payment from me. I couldn't afford it. So then the IRS was threatening to garnish my wages. I'm already living paycheck to paycheck. That would have put me over the edge financially.
It truly seemed hopeless, but then a friend at work told her to call the tax relief line.
The people at the tax relief line, they told me about something called innocent spouse relief. They worked it out so that all of the taxes from my ex are not my problem. I don't know how that works, and I don't care. All I care about is that I don't owe the IRS a dime, and they are not going to take my paycheck.
Even if it seems hopeless, you should call the number on your screen right now. There is absolutely no cost for the call or the consultation. You are under no obligation. If you are worried that the IRS could garnish your wages, seize your assets, even take your home, call us right now. The Tax Relief Line is here to help you. Now you have a knowledgeable, professional team of tax experts that are ready to negotiate with the IRS and fight for you to save you money. The Tax Relief Line's professionals have successfully negotiated thousands of cases, reducing and sometimes even eliminating the tax debt for their clients. It's very easy to get started. Simply call the number on your screen right now. You don't have to live in fear anymore. The call and the consultation are free.